Many individuals find themselves financially stagnant, despite years of working hard and attempting to invest. There's a common frustration that grows when effort doesn't translate into expected financial progress. This persistent lack of growth often isn't due to a lack of intelligence or effort. Welcome to another episode of the Simply Speaking About Money video series, where today we talk about investing in probabilities, not the hype and crazy promises of possibilities. Instead, the true root cause frequently lies in a fundamental misunderstanding of how successful investing truly works. It's about the underlying mindset, the mental framework through which investment decisions are made. This framework dictates whether your efforts yield consistent returns or lead to repeated disappointment. If you like simple, no-hype explanations about money, hit the like button, subscribe, and turn on notifications. This channel is about clarity, not clickbait, and that small action helps more people find calm, rational investing content. Today, we're going to explore two distinctly different approaches to investing: possibility investing and probability investing. These two philosophies represent a critical fork in the road for anyone looking to build wealth effectively. Understanding their differences is key to unlocking your financial potential. One of these approaches often feels exciting and promises rapid, life-altering gains, but frequently leads to financial setbacks. The other, while often perceived as boring, consistently delivers sustainable and reliable growth over the long term. Let's uncover why most investors inadvertently choose the path of excitement and how you can avoid its pitfalls. Possibility investing is an approach driven by focusing on what could happen rather than what is genuinely likely to happen. It's about betting on extreme, often low-probability outcomes that promise extraordinary returns. This mindset often emerges from a desire for massive, life-changing financial wins. This type of investing is characterized by chasing the next big thing, fueled by the belief that this stock could explode or this cryptocurrency is going to the moon. It's an optimistic, albeit often unrealistic, pursuit of the fastest route to wealth. Such enthusiasm often fuels trends like meme stocks, viral online trading communities, and various cryptocurrency hypes. It's easy to confuse the genuine excitement and optimistic outlook surrounding these investments with a sound, defensible strategy. However, while the thrill is undeniable, it rarely translates into consistent, long-term success. This approach leverages hope more than historical data or statistical likelihood. The reasons for its frequent downfall are numerous and consistent. Success stories in possibility investing are often very loud and widely celebrated, but they are rarely repeatable for the average investor. Conversely, the vast majority of failures happen quietly, remaining unseen and unheard. This creates a misleading perception of success rates. This approach inherently relies on very small chances of huge success, which unfortunately leads to disappointing average outcomes across a large number of attempts. It's like buying many lottery tickets. While one could win, most will not, resulting in a net loss. This strategy also demands virtually perfect timing. Investors need to buy incredibly early, sell precisely at the peak, and somehow avoid panic during inevitable market corrections. Emotional decision-making plays a huge, destructive role here. Greed takes over when prices are rising, pushing investors to buy at unsustainable highs. Fear then paralyzes them or triggers panic selling when markets inevitably fall, locking in losses. This constant emotional roller coaster hijacks any semblance of a rational investment strategy. Possibility investing also magnifies a sense of urgency, making every market movement feel critically important and demanding immediate action. This constant pressure can lead to impulsive, ill-considered decisions. Furthermore, even a single successful speculative win can teach the wrong lesson, encouraging investors to chase more fleeting opportunities rather than adopting a sustainable strategy. This false positive reinforcement can be one of the most dangerous traps Probability investing, in stark contrast, is an approach built on what usually happens over extended periods. It acknowledges that short-term market movements are incredibly unpredictable and often chaotic. However, it strategically leverages the consistent, long-term upward trend of well-diversified markets. This strategy involves spreading investments across a broad range of assets, significantly reducing reliance on any single winner or sector. Instead of trying to pick individual market darlings, it bets on the overall growth and resilience of the global economy. This systematic approach is the bedrock of long-term wealth creation. Core principles of probability. Investing include aggressive diversification, consistent automation, and unwavering patience. It's about setting up a robust system that works for you rather than constantly reacting to market noise. While this method might not offer the dramatic headlines or instant gratification of possibility investing, its track record for building wealth is unparalleled. Probability investing often feels less exciting precisely because it lacks drama and adrenaline. It focuses on the steady, compounding growth that comes from broad market participation. The thrill is replaced by the quiet confidence of a well-executed plan. The reasons for its consistent effectiveness are straightforward and powerful. Probability investing minimizes emotional decision-making, which is the undoing of so many investors. By automating investments and adhering to a predefined strategy, the urge to react impulsively to market swings is significantly reduced. Financial tools and platforms like Acorns exemplify this approach by promoting diversified, automated portfolios. They make it simple for anyone to invest small amounts regularly into a broad range of assets, embracing the power of consistent, low-effort participation. Automated investing, such as rounding up spare change, relies on the statistical probability of market growth over time, not on personal predictions or speculative bets. This hands-off systematic approach eliminates the need for perfect timing or picking winners, focusing instead on consistent market exposure. To truly understand the difference between these two mindsets, let's use an analogy that most of us are familiar with: air travel. When considering flying, a possibility investor might dwell on the rare, catastrophic event of a plane crash. They might focus on the slim chance of failure, letting it overshadow the overwhelming safety statistics. This perspective, while based on a possible outcome, ignores the highly improbable nature of such an event for any individual flight. A probability investor, on the other hand, acknowledges that while plane crashes are indeed possible, they are statistically incredibly rare. They understand that the overall safety record of air travel is outstanding, making it one of the safest modes of transportation. This perspective focuses on the overwhelming likelihood of a successful journey based on vast amounts of data. In the world of investing, rare financial disasters or spectacular, one-off successes tend to grab all the headlines and attention. These sensational stories can overshadow the quiet, consistent success achieved by thousands of probability investors every single day. The consistent, boring path to wealth building rarely makes for compelling news. Probability investors accept that there are small, calculated risks inherent in any investment. However, they make their decisions based on the long-term odds, which are overwhelmingly favorable for diversified, consistent investing. They understand that by playing the long game with the odds in their favor, consistent success becomes not just possible, but probable. They prioritize statistical likelihood over speculative possibility. Making the shift from possibility to probability? Investing is a deliberate choice that requires a change in mindset and habits. It's about re-evaluating what you truly seek from your investments and aligning your actions with those long-term goals. This transition begins by challenging ingrained behaviors and embracing a more systematic approach. The first crucial step is to stop trying to be impressive with your investment choices. Forget about finding the next viral stock or boasting about a sudden, massive gain. Instead, Prioritize creating a repeatable, reliable system that consistently builds wealth, even if it doesn't make for an exciting story at dinner parties. Your financial future isn't a competition for the most dramatic story. Utilize automation wherever possible to reduce emotional influence and decision fatigue. Set up automatic transfers to your investment accounts and implement automated, diversified investment strategies. This hands-off approach takes the guesswork and emotional impulse out of your investing, making your financial growth predictable and consistent. Second, focus intently on consistency, not on trying to time the market perfectly. Regular disciplined investing, often through dollar-cost averaging, consistently outperforms attempts to buy low and sell high. History clearly shows that even professional investors struggle with market timing, making it an unreliable strategy for long-term success. Your goal should be to consistently participate in market growth over time. Third, commit to diversifying your investments early and often. Never allow any single stock, sector, or asset class to dictate your entire financial future. By spreading your capital across various investments, you cushion yourself against the inevitable volatility and underperformance of individual components. Diversification is your primary defense against unforeseen market downturns. Finally, you must learn to give time its proper role. Patience is paramount. Probability-based investment strategies are not about quick wins. They are about leveraging the power of compounding over decades. These strategies require patience to truly yield their incredible results. Trust the process, stay invested, and allow time to work its magic on your growing portfolio. In essence, possibility investing tantalizes with promises of exciting, rapid financial transformation. It offers the allure of instant wealth and dramatic, life-altering gains, drawing investors into a game of high stakes and high risk. This path often leads to disappointment, stress, and ultimately, underperformance as the odds are consistently stacked against it. Probability investing, on the other hand, offers a quieter, more dependable path. It delivers steady, compounding, and truly sustainable financial progress over the long term. This approach doesn't promise fireworks, but it consistently delivers robust growth, building wealth through disciplined and diversified strategies. True, enduring wealth is fundamentally built by consistently benefiting from what usually happens in the markets. It's about aligning your investments with the historical and statistical tendencies of global economic growth. This systematic low-stress method is the bedrock of enduring financial security. It is crucial to remember that this content is provided for educational purposes only and is not personalized financial advice. Your individual financial situation is unique and requires specific considerations. We encourage you to seek guidance from a qualified financial advisor. Budgeting is step 1. Investing is step 2. That's where Acorns comes in. Acorns helps you start investing automatically, even with your spare change. It rounds up your everyday purchases and invests the difference into diversified portfolios built for long-term growth. You don't need thousands of dollars. You don't need to be an expert. You just need to start. When you pair smart budgeting with automatic investing, you build momentum, and momentum builds wealth. If you're ready to make your money work while you sleep, check out the link in the description to get started with Acorns Affiliate Disclosure. I may earn a commission if you sign up using my link at no extra cost to you. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further.